Hello, morning viewer. Welcome back to my channel, Hocantalk. Now today, this video, I'm going to teach you another very commonly heard financial term called exchange traded funds. In short, it's called ETF. So as usual, this video will be presented in two languages, English and Chinese. So for the ease of my viewer, if you want to listen to English, this will be the one, and I will do one which is not a direct translation. I will do another in Chinese. Again, if you like my video, if you think that my video has benefited you, please subscribe and also forward my video to all your friends so that I can receive more subscription, because I really put in a lot of effort to prepare each video and really sincerely teach you all this knowledge. Now, today, again, the same thing will be marker and pen. So I will use marker and pen to transfer all my experience and knowledge about ETF to you, so that hopefully it will benefit you in your career, in your day-to-day business decision making, or even your general knowledge. Now, look at the slide. Exchange traded funds, in short, we call ETF. In Chinese, we call 交易所交易基金. Okay. Now, first and foremost, I want everybody do not be worried about terms like ETF. It sounded very complicated. It sounded like very advanced, like a lot of things behind. No, actually, it's very simple idea. Now, if you remember, I assume all of you are fully aware of what is a mutual fund or what is a managed fund. For those who need me to make a video about fund, you can drop me a comment. I will do one so that everybody can benefit. Now, in the past, many years ago, I was also a fund manager. So when we manage fund, every day I will go and tell people, or tell those rich people or investor, say that I can manage your money better than you do. So please put your money with me, and I will charge a fee, or sometimes even profit sharing, and I will manage this money for you, and I will measure my performance against a certain benchmark. So that was in the past. So when the investor say, oh, okay, fine, I like to invest in your fund, they will give me hard cash, and I will give them the share of the fund. In this case, will be called the unit trust. So then I will take all this money and go to the market and start to deploy this market, like buy blue chip, buy all kind of shares, or whatever thing that I think they are good enough. So this was in the past, but there are still a lot of mutual funds not listed. So now what happened when the investors say, okay, now I don't want to invest anymore, what can they do? They will call my bank or my fund management company, say that, hey, I want to redeem the fund. So when I receive a notice through instruction, like for example, when I'm the fund manager in the morning, I saw, oh, there's a redemption of 2 million. Then what I'll do is that I will start to sell some shares in the fund, and then raise the cash and transfer the cash. My settlement department will transfer the cash back to the investor. So in this case, the investor can make money or they can lose money. Of course, there will be a lot of fee involved in the transfer, in the redemption as well. So that's the only way an investor who invested in a fund, when they want to redeem, is to go through me, my company, say that, and issue us a notice, say they want to redeem. Now, then some fund manager will think that by doing so, there's no liquidity. So it's very slow to accumulate fund, and a lot of investors want liquidity. So what they do is very simple. That's why they call ETF. Okay, so someone smart enough, they say, why don't we list the fund on the stock exchange to allow secondary trading, meaning whoever want to sell the fund don't have to go through redemption. They can go to the market and sell away the unit trust. So it's nothing more than a listed mutual fund or listed fund. It's just like a company lists their share, but in this case, a fund lists its shares on an exchange. So now, what are the features of ETF fund? So ETF fund it's just like a mutual fund, but the only thing is that it is listed on an exchange. So that's the only thing. And also because the ETF fund, exchange traded fund, they try to mirror or follow certain portfolio or certain index. So the value adding of the fund manager might not be that high. is very much more so like administrator role. Of course, they do have there are some active managed ETF fund, but a lot of the ETF fund are passively managed, meaning that they just want to mirror something. So they construct a portfolio, and when there's a new money coming in, they'll buy more. When there are less money, when there are redemption, they will sell. They will unload some of these shares or portfolio and give it to the outgoing investor. So in this case, let me talk about the feature of ETF. Now, number one is tradable. Like I mentioned, since it's listed, people who want to buy, sell, instead of going through a redemption process, they can instead sell the unit trust on the market. So it's tradable. Diversified. Now, for a ETF, generally is a very diversified portfolio and it discloses daily. So for example, this ETF has a portfolio of share, about 100 share. So every day they will disclose this and it's properly diversified. To have major changes to this diversification of this portfolio require a committee meeting of the fund management company before they actually effect all these changes. That's why, because it become a very passive kind of investment or centralized kind of investment, the fee that they charge is generally lower than a non-listed mutual fund, because that require the specialties of a fund manager who actively got to anticipate where the market is going on, how to make sure that we outperform. I'm not saying that ETF does not outperform, but ETF main objective is to mirror a certain market portfolio. Number three is transparent. All the shares inside an ETF fund are fully disclosed to everybody. So at the end of the day, you can go and see what are the share or what are the bond in the ETF. Number four, because I mentioned is very much more administrative than management role. There are still management, but it's more administrative. So the cost will be kept much lower. The rest, and like I mentioned, ETF fund, most of them are passive, meaning that they actually mirror certain things like the Standard & Poor index, like some big New York Stock Exchange index or Nasdaq index. They mirror all the stock inside that index. Okay, so they don't really do a lot of changes. The only thing they might do is maybe this stock, the percentage of this stock in the index is 3%, but maybe in this ETF they might go up to 3.2 or 2.9%, depend on certain view. So, but again, they try to mirror exactly the index. Okay, so that's why it is a passive. But there are also ETF that are active, meaning that the fund manager or fund management company who manage this ETF will try to put in some separate decision making to make sure that the performance of the portfolio can outperform the benchmark or the underlying index. So these are the active ones. Now, how about the history of ETF? Like I mentioned, again, someone who manage fund must realize that the disadvantages of manage a fund is there's no liquidity for investor to exit. So, and every exit investor one will have to go through a redemption. It's very disruptive to a fund manager. Assuming today someone put money with you and you buy the share. Tomorrow someone say I don't want really, I want to redeem, then you got to sell the share. So it becomes very disruptive. So in order to make sure that is not the case, and also to give more liquidity to a fund so that to attract more investors willing to put money in the fund, or those who have not willing to put money in the fund but willing to trade the fund, they can go to the stock exchange and trade the unit trust of a fund. It's something like a share. So this concept was mooted in early 90s. So in the year 1993, the first ETF, mirror Standard & Poor 500, was listed on New York Stock Exchange. So that was the first one. So again, ETF is nothing much other than a fund get itself listed on the stock exchange. That's all. So in the year 2000, the total size of the ETF is about 70 billion US. 70 billion US. In the year 2024, it ballooned to about 13 trillion US. I think in the year 2025 is about 19 trillion already. So the size become bigger and bigger and bigger. Of course, this is the benefit of having liquidity. So when the investor invests in a fund in the past who are not listed, they always worry, oh, I want to redeem. What happens if the fund manager say cannot redeem? Like recently, one fund management company said that you cannot redeem because there are liquidity issue. They don't have enough liquidity, or the underlying portfolio cannot be sold without a significant change in value. So they will say they cannot redeem. Then this investor will be stuck in the fund. But with a listed with an ETF, meaning the thing is listed, then they can go to the market and sell. But this in theory lah, in theory, in good time, there will be enough buyer, enough seller. But when the market crash, even if it's listed on the stock market, beware, investor, even if it's listed on the stock market, when you want to sell something, if there's no buyer, you can't exit also. So listing, the advantage of listing is only applicable when the market is operating normally. But when the market is going through a turbulence, there might not be any buyer at all. So in this case, even there's money, market maker, even if they don't want to make market, that means there's no liquidity. It's as good as a fund that's not listed. So we always have to bear in mind a balanced view of risk and return. Do not always assume that the ETF fund can be always easily sold. That's depending on the market condition. Now, like I mentioned, ETF fund is just a fund listed. So there are actually two layers of activity. Now, the first layer is called the primary layer, and the second layer is called the secondary layer. Okay, the primary is very easily understood. Do not be worried by the term like authorized participant, ETF issuer. Now, primary meaning that if you look at the slide, primary meaning that before a fund is listed, how do you invest and how do you redeem? You come up with cash, you go to the fund manager, say I want to invest. The fund manager will use a laser printer to print out the unit trust certificate and give it to you. They will get your cash, they'll go to market and start to buy the share. But when you want to redeem in an ETF fund, likewise, not buying and selling the unit trust on the stock market, but you want to redeem, meaning you want to take out money from the fund rather than sell away the unit trust of the fund. Then you have to go through the primary channel. You go to your banker. You just inform your banker. Please inform the fund manager, or you go straight to the fund manager. Say that I am the holder of X amount of ETF. Now I want to redeem. So in this case, instead of selling in the market, you also can go for actual redemption. Instead of buying in the market, you can also go straight to the fund manager, go to those authorized party to buy new share in the ETF. When you do that, the fund manager will receive fresh money. Okay, so this is called the primary trading, meaning there are new money going into the fund or money leaving the fund. So this is the primary trading. It's exactly like a normal fund. When you want to invest, fund manager got more money. When you want to redeem, they have to give you back the money. But in this case, for ETF, many cases, they will not give you the money, the cash, but they will give you the respective all the relevant shares. For example, if they have 100 shares, if you redeem, then they will give you certain portfolio in terms of shares. But again, there are some ETF will also return you the money, or maybe it's a mixture of both. But there are also a significant activity happening on the secondary market, meaning that even if you are not the investor in the fund, you still can trade the fund. For example, if you are not investor of a gold ETF fund, but you think the gold price is going up, so instead of buying physical gold and put it inside your safe, that which you need to pay custody fee, you can go to the stock market and look for a traded ETF fund for gold. So you can go and buy and sell the unit trust. Those money that you buy and sell will not go into the fund. It will not make the fund bigger. The money will go to another one who wants to sell the fund to you. So it's just like us trading. The money switch between secondary market player among investor. Okay, it doesn't go to the fund, neither does it leave the fund. Now, if you look at this slide, the primary side will be authorized participant, those banker, fund manager, broker, custodian bank who help you to redeem or subscribe to the fund. And the ETF issuer usually are the fund manager company like BlackRock, Blackstone, all these companies, Vanguard. Secondary market, who are they? Who are the player? People like all the retail investors who are not even invested in the ETF fund, but they just want to trade. They think the the price of ETF, the unit trust price will go up, then they'll go and buy. If they think it will go down, they will start to sell. So this create liquidity, okay? Now, so they are retail investor, they are institutional investor, and they are also someone called the market maker. Market maker meaning there are certain bank who purposely put up some buy order or sell order to make sure there is liquidity in the market. So that with liquidity, then more people want to play. So if there's no liquidity, no one will want to play. So when there's not enough liquidity, people who want to sell might have to sell at a loss, okay? Or people who want to buy might have to buy at a high price because there's no seller. Okay, so this I explained these two things to you all in details. Now, what are the types of ETF available in the market? There are many types. So it's a transformation from a normal non-listed fund to a listed fund. So if in the past you have equity fund, you have bond fund, you have commodity fund, you have real estate fund, you have multi-asset fund, you have currency fund, then you also find the same kind of fund in ETF. The only thing is they actually go and list this fund. So it's nothing new. The only thing between a traditional mutual fund and an ETF is ETF is listed, but the traditional fund is not listed. So again, I list down all the types of ETF fund. So you have equity, bond, commodity, real estate, multi-asset, meaning it include real estate, share, bond, everything inside, or you have plain currency ETF fund. Now, talking about the strategy, even though the ETF fund is more passive, but they also deploy different kind of strategy to enhance the return. So this is very much how the fund manager want to run the money inside this fund. So they can do it on a very passive manner, meaning they just follow exactly the benchmark portfolio. They just do switching. When there are new money coming in, they buy more. When there are less money, when their money redeemed, they'll unload some of the share into cash, or they will transfer the share through central depository agent to the one who redeemed. Or they can do it actively, meaning that they might change the component or the percentage weightage of some shares in the index, so to try to outperform, so they can be active. Now, smart beta, they also, some of them are absolute return. For example, I don't link my performance to a portfolio. I will try to outsmart the sensitivity of the stock market. So it's an absolute return kind of thing. So they also have this kind of fund. It's just a hedge fund. So if you see X amount of mutual fund, you will see X amount of ETF, because they actually get them listed. Okay, the fourth one will be leverage, meaning they borrow money to increase the return on investment. And there also some called the inverse meaning that those funds who profit when the market drops, so they actually do short selling, a naked call, they can do option and all this. No, of course there are some fund called the thematic meaning that they focus on certain topic like solar energy, renewable energy, space technology, agriculture. So they will buy all those stock or bond that link to agricultural industry. Okay, so these are the strategy of the ETF. Now let's look at how big the global global market asset. The whole global ETF in the year 2024, just now I put down about 13. So in this case, I rounded up to 14 trillion. The number of ETF funds listed in the world right now is about 11,000 of them. The party involved about 700 plus. These are mainly the fund manager who manage the fund in the past, but they actually get them listed. And of course, the fund manager in USA actually make up 70% of the global market share. They are the more active players. So a lot of big fund management company in USA, they actually listed their fund. Now, come back to the asset thing. For 2025, I think this figure is about 19 trillion already. 90 trillion, 19. Now, how about breakdown of assets? So from here, you can see out the 11,000 ETF in the world, how many is in equity and bonds. So those in equity for 2024, there are about 11 trillion in equity. So you can see that most of the ETF listed in the world are all equity ETF. Now, there are some who do bond, about 2.5 trillion. Some who do commodity, there's about less than 250 billion. And alternative, meaning all kind of different strategy other than equity, bond, and commodity, is about 200 billion US. Now, who are the who are the major issuers? So this one you can guess yourself. It should be all the big fund manager. So they manage many funds. So in order to suck in more money for management and earn a fee, they will want to give liquidity to the fund that they manage by listing the fund on a stock exchange, so it become a ETF, exchange traded fund, so the investor will feel more comfortable to put their hard-earned money with them, and they will earn management fee. And of course they also gain financial muscle, because through ETF they actually are the major shareholders of a lot of big company in USA. For example, Apple, Google, uh, you know, you name it, these are the top people. But of course they make the decision on behalf of all the investors that put money through the fund. So the one that make the decision is not actually the investor that come out the money, it's the fund manager that come out money. do does do all these pose a threat? Again, this will be a topic of another video. So if you look back on the ETF issuer, you can see BlackRock, Vanguard, State Street, Invesco, Charles Schwab. So these are the common name, and all these American players, they are 70% of the market share in the world, because financial market is still more vibrant in USA as compared to the whole world. Okay, the last slide, let's talk about the advantages of ETF. Of course, this one, like I mentioned many times in this video, is lower cost, because a lot of things are more administrative rather than management. They mirror certain index portfolio, or they will give you a standard portfolio, and the fund will just simply try to follow the portfolio, the composite of the portfolio, exactly as possible. So that's why, because of that, less decision making, less insight need to be put in. They can make this automated process, or they can even use AI to do it. That's why they charge a lower cost. Okay, so the management fee of the ETF is lower. Now, liquidity, because it's listed on the stock exchange, it is highly liquid. You can sell and buy anytime. But again, this is under normal market condition. When a market crash or went through a crisis, I'm very sure all those people who invest in shares and bond in the market, even in mutual fund, you don't think that you will be able to find buyer. You can put your price lower and lower and lower, but there is no buyer. So again, liquidity is always subject to market condition. Now, diversification, again, ETF fund is just like a mutual fund. They are supposed to hold multiple shares, multiple asset classes to diversify the risk. So in this case, for ETF, likewise, okay, doesn't mean they are listed, they can go take high risk or can do concentrated kind of betting. The answer is no. So again, this video coming to an end. I hope that after my video, you do not have to worry about big terms like ETF. Basically, they are just a mutual fund. They are listed on the stock exchange, allow people to buy, sell rather than redemption. But for those people who actually want to put money into the fund, they still have to go through subscription and redemption just like a normal fund. But for those people who actually just want to trade, or those who not even the investor in the fund, but they just want to be a speculator, then they can go to secondary market and buy, sell all this ETF fund. So again, I hope today I've give you all the necessary knowledge about ETF, and please do subscribe to my video. It's really difficult, and took a lot of effort to produce a good video. And also, if you benefit from my video, please circulate to your friends so that they can also benefit from this video and subscribe to my video. Again, thank you very much. See you next video. Bye bye.